Welcome to this special edition of the FreightLoop by Drewry. My name's Eleanor Hadland. I'm a Senior Associate of Ports and Terminals with Drewry Maritime Research. Today I'm pleased to be joined by my colleague Eirik, who works alongside me within our Ports and Terminals research team. And in today's session, Eirik and I will be taking a closer look at the recently announced mega deal between Hutchison and a consortium formed by BlackRock TIL, breaking down the details, sharing some of the key insights and our thoughts on what this major commercial move means, not just for the companies involved, but for the wider global terminal operator sector as well. So Eirik, perhaps you can give our listeners a quick overview of the deal.
Hi Eleanor. Yes, let's take a look at the key players. First up, we have CK Hutchison, the Hong Kong listed conglomerate that holds an 80% stake in Hutchison Ports, having sold a 20% stake to PSA back in 2006. Hutchison Ports was one of the first operators to be classed as a global player. It secured multiple concessions in the 1990s and early 2000s, but having secured its position as a major player, it has since relied primarily on organic growth across this portfolio to attain its position towards the top of our annual league tables.
So that's the sell side covered. Who are the buyers?
Well, the announcement identified a consortium formed between Terminal Investment Limited, TIL, and BlackRock, which is a major investment firm listed on the New York Stock Exchange.
And how did these two companies come together?
There's actually an existing relationship. So TIL is majority owned by MSC, the world's largest container shipping line, which holds a 70% stake. Global Infrastructure Partners holds 20%, and the Singaporean wealth fund GIC holds the final 10%. However, it was BlackRock's acquisition of Global Infrastructure Partners in 2024 that created this link with TIL.
I see. So that's the who of the deal covered. Let's move on to the what.
Yes, the deal includes all of Hutchison's terminals outside of Hong Kong and China. So this covers terminal assets and associated businesses in 43 ports in 23 different countries across the globe. It excludes the mainland China and Hong Kong assets, a large proportion of which are operated by Hutchison Port Holdings Trust, which is a separate company that's listed on the Singapore Stock Exchange.
So the deal does include these terminals in Panama that were grabbing headlines even before this announcement?
Yes. Hutchison Ports holds a 90% stake in the Panama Ports Company, which operates terminals at the Balboa, at the Pacific entrance of the canal, and at Cristobal at the Caribbean Sea entrance.
And some commentators appear to suggest that President Trump's recent pronouncements on Panama have actually been the key driver for the deal. But would you agree that the timescale for this is just too short for this to have really been a factor?
Yeah, absolutely. Deals like this take time to negotiate. And while we can see that the structure of the deal has been adjusted to take into account the lawsuit challenging the Panama concessions, which is essentially creating a separate transaction for these assets, the parties will certainly have been discussing this prior to the second Trump presidency starting. Nonetheless, the protectionist rhetoric in the run-up to the election and the shift in sentiment towards Chinese and more recently to Hong Kong companies will have been a factor in CK Hutchison's decision to largely withdraw from the global port sector. Now, on the buy side, MSC's recent departure from the 2M alliance will have increased its appetite to secure terminal capacity at critical hub ports, which is something it will have been planning for since 2M made the announcement of the split more than 2 years ago.
That's great. But what about this valuation? The announcement detailed an enterprise value of $22.8 billion for the assets, and this dwarfs anything we've previously seen in the sector.
Yes. The acquisition price implies an EV/EBITDA multiple of 13.6 times, which is higher than the globally listed port companies under coverage by Drewry Maritime Financial Research Team, which record an average of 10 times, indicating that there's a premium valuation. Now, CK Hutchison is set to receive around $19 billion for the deal, almost equal to its entire market capitalization, which of course was going to be very attractive to the company and its shareholders.
So it looks like BlackRock and TIL are paying a premium. Does the Hutchison portfolio actually warrant this?
Well, arguably, as the deal has been announced, then it would appear so. However, taking a closer look at the Hutchison portfolio, we can start to see why this might be the case. Firstly, we need to take a bit of a trip down memory lane. Remember the mid-1990s when we both recently started work in the port sector?
Well, it's a bit hazy, but let's suppose I can remember that far back.
Yes, we're showing our age now. So Hutchison was one of the first companies to build an international portfolio of terminals. At the time, the container market was growing strongly, recording double-digit growth each year, and state-owned ports were under pressure to invest in purpose-built container terminals. There was a wave of terminal privatizations, and Hutchison built the core of its portfolio in the 1990s and the early 2000s, securing a raft of terminals in strong gateway markets, such as the Netherlands and the UK, as well as emerging markets in Southeast Asia and Latin America. Then, following the global financial crisis, CK Hutchison effectively moved into the slow lane. It relied primarily on organic growth and existing terminals and treated the segment as a cash cow. Other parts of its business, such as telecoms, had high growth potential and high capital requirements. And as a result, Hutchison has gradually dropped down our global operator league table. However, because of the long-term investment horizon that we see in the sector, Hutchison has continued to benefit from the first mover advantage it secured more than 20 years ago. It's the dominant operator in major ports, including Rotterdam, Amsterdam, and Karachi. It's the largest player in the Mexican market with 4 terminals, and it holds significant stakes in terminal operators in Port Klang and Jakarta.
So, long-term concessions actually act as a barrier to entry to other operators in these key markets. And because growth rates are now significantly lower than they were 20 years or so ago, this means there's actually now also fewer greenfield opportunities on offer to enter these markets as well.
Yeah, exactly right. So if you recall, we had a similar discussion when MSC acquired Bolloré Africa Logistics, highlighting that targeted M&A can affect buy market share that would otherwise take decades to achieve organically.
I see. So the premium actually starts to look worthwhile when you consider that in most cases, there's actually no other route into these markets.
Absolutely, yes. And as MSC's line of services are already calling at many of these ports, then there's further justification for the deal, as this would ensure that more of MSC's expenditure on terminal handling is retained in-house and it retains an element of operational control. So, Eleanor, how do you think the deal will progress?
Well, the announcement highlights that the deal is subject to confirmatory due diligence together with other completion procedures, such as addressing any change of control provisions in both shareholder agreements and concession agreements. We also expect that competition regulators in the affected markets will be taking a keen interest in the transaction. When we look at the timeline of recent deals, MSC's acquisition of a minority stake in HHLA, which was subject to review by the German Parliament, was completed in around 14 months. The sale of Bolloré Africa Logistics to MSC was completed in 1 year, and the sale of the SARM terminals to Hapag-Lloyd was completed in 10 months. So I think for this deal, we have to expect it to take at least a year to wrap up all the details.
But what about the competition issues you just mentioned?
Yes, well, I've compared the portfolios, and in the main, they're pretty complementary. But we have identified a number of port ranges where the risk of excess market concentration appears high. Now, first up is the Northwest European port range. TIL has a significant presence in Le Havre, Antwerp and Bremerhaven, and a JV agreement for a terminal in Rotterdam. And MSC acquired a 49.9% stake in leading Hamburg operator HHLA last year. Meanwhile, Hutchison's the majority shareholder in ECT. That's the largest terminal operator in Rotterdam. The European Commission's competition authorities looked at all the major deals in this port range, so we can be certain that this deal will fall under their remit. We'd also expect the EC to take a look carefully at the Spanish market, since TIL is the major operator in Valencia and Hutchison controls the largest terminal in Barcelona.
And is there anywhere else?
Well, Panama is a concern. As you just stated, Hutchison's got its 90% stake in the Panama Ports Company, and its facility at Balboa is located directly opposite the Rodman terminal, and TIL is a joint venture partner in this facility alongside PSA.
And if the regulators decide that the deal creates excess market concentration, then what happens?
Well, the usual remedy in these circumstances is to divest assets in the affected markets to reduce market share to a level deemed acceptable to the regulators. In Rotterdam, we see that probably it's going to be the Euromax terminal that's the most likely to be divested. EC2 holds only a 65% share in the facility, and it was reported in August 23 that Evergreen would acquire a 20% shareholding in the terminal. And although it doesn't appear that this deal has been finalised yet, it does seem to suggest that this isn't such a core asset for Hutchison compared to its other facilities in the port. So, Eirik, were you surprised when the deal was announced?
Not entirely surprised. MSC was the fastest growing global terminal operator in 2023 due to its acquisition of Bolloré Africa Logistics, and its deal pipeline was already strong enough to maintain this level of growth. When we published our annual review of global container terminal operators back in July, the acquisition of a 49.9% stake in HHLA was underway, and since then we've reported on the company's acquisition of Brazil's Wilson Sons, together with a further 4 M&A deals and 6 concession agreements involving either TIL or AGL, all of which make the company by far and away the most active in the market. So if anyone was going to make this deal, then MSC seemed the most likely candidate. And the tie-up with BlackRock has provided them with the funds needed to make it happen.
So why not PSA, given they already hold a 20% stake in the business?
Well, it was only 2 years ago in 2023 that PSA were reported to be considering divestment of their shareholding in Hutchison Ports, with the leading Chinese operators, that is COSCO Shipping Ports and China Merchants, seen as the most likely investors. Although that process didn't result in a deal, it shows that PSA was happy to exit the business.
And do you think they might take the opportunity to sell now, especially given the valuation?
I'd expect that they will certainly consider the option to sell very carefully, but currently it's not very clear if the TIL-BlackRock consortium would actually want to increase their investment to take 100% control of the Hutchison portfolio. The valuation is significantly above the reported $4 billion that PSA was seeking for its 20% stake in Hutchison, especially given that the $22.8 billion enterprise value excludes the mainland Chinese assets. Of course, obtaining 80% gives BlackRock and TIL consortium the effective control of the business, while the 20% stake offered by PSA 2 years ago was not going to allow the investor to exert much influence over the direction of travel. On the other hand, PSA could decide to stay put and see if the new ownership results in a more dynamic business model. PSA and TIL already have a number of GAVs in place in Singapore, in Antwerp, Busan, in Sines and in Rodman. So there are established relationships between the current and new shareholders in Hutchison. So a final option could see some behind-the-scenes efforts to better align the Singaporean government stakes in the Hutchison portfolio. So GIC, which we mentioned earlier, holds a 10% stake in TIL, is itself a Singaporean government investment fund, while PSA International is owned by Temasek, which is another Singaporean government investment fund. So we can see some sort of alignment with those two entities. So Eleanor, while we're talking about PSA, will this deal see a new number 1 in the global container terminal operator market rankings?
Well, it certainly looks like this will be the case, but obviously not until the deal is finalised. Now, I'm sure anyone who follows our analysis of the sector knows that we use 3 key metrics to rank these companies. Firstly, we look at total throughput, which is a gross measure of throughput, and we count all terminals in which the global operator holds more than a 10% direct shareholding in this metric. We use equity adjusted throughput, which adjusts the terminal throughput pro rata to the equity stake in each terminal asset. But this measure also includes volumes handled by other terminal operating businesses in which a global operator holds an equity stake. So under this measure, we allocate 20% of Hutchison Ports throughput to PSA. We generally use the equity adjusted measure when ranking the operators, as this accounts for the different levels of shareholding across their respective portfolios. Finally, we use capacity, and this looks at the total operational capacity of the terminals in which the global operators hold a direct shareholding. So as soon as the deal was announced, unsurprisingly, we looked at how this would have impacted the rankings. And we've had to use 2023 as the base year, as this is the last full year for which we have figures. Now, back in 23, MSC ranked 7th in the equity adjusted throughput league table with reported volumes of 42.3 million TEU. And that includes TIL, AGL and other portfolio companies. PSA, in contrast, ranked first with 62.6 million TEU. Hutchison, on the basis of its entire portfolio and Hutchison Ports Trust, ranks sixth with 43 million TEU. But that 43 million is after the adjustment for PSA's 20% stake. When we look down at the assets, though, that are within the transaction perimeter for this deal, then the throughput is reduced to 32.6 million before the adjustment for PSA shareholding and 26.1 million TEU after the adjustment. So the addition of this 80% stake in Hutchison is more than sufficient to propel MSC into first place in the rankings. And all of our calculations based on 2023 are before we compile, or we take into account rather, the impact of the HHLA concession, the acquisition, plus all those other deals and developments that you've just mentioned. However, probably the magnitude of the deal is most clearly seen when we look at the short-term capacity outlook for the businesses that will fall underneath the MSC umbrella. Before this deal was announced, we had expected that MSC would add an additional 30 million TEU capacity to its portfolio by 2028. And that was going to be achieved via expansion at its existing portfolio of terminals operated by TIL and AGL, and also the acquisition of its stake in HHLA. The addition of the Hutchison portfolio adds a further 80 million TEU capacity into the mix, meaning that if this deal progresses by 2028, MSC will hold an equity stake in terminals with a combined capacity of 220 million TEU, and that's equivalent to 15% of forecast global terminal capacity. In contrast, PSA will hold a stake in terminals with a combined capacity of 150 million TEU, so just over 10% of forecast global capacity.
Wow, 15%, that's a massive step up. That gets me to thinking about how the other global terminal operators might be viewing this deal.
Well, I'm assuming that there's a level of concern at all levels about what this might mean for their business. So what have you heard so far?
Yes, it's definitely fair to say that they're concerned. MSC is a major customer at many global terminal operator terminals, and this deal presents a risk because it will almost certainly impact on current commercial relationships. There is a risk that terminals operating in the same, so located in the same port or port range as Hutchison facilities, could lose MSC services, but this will need to be assessed on a case-by-case basis. Of course, there will almost certainly also be carriers that are currently using Hutchison terminals that might be looking to change suppliers due to the change in ownership. But until we know more about the ownership structure and proposed management, then it's almost impossible to judge the magnitude of these shifts.
Can you see any upside?
But potentially, as you've already highlighted, there may be a requirement for the new owners to dispose of shareholdings in some assets in key markets, which then creates market entry opportunities for other players. Also, MSC are likely to invest in upgrading Hutchison terminals to ensure they're ready to handle their fleet. And these investments in deeper quays, in higher outreach cranes and higher density yards have the potential to benefit all customers, not just MSC.
So, what do you think the key takeaways are at this stage?
Well, at this early stage, the deal just confirms that hybrid operators, that is, terminal operators owned by carriers, are gaining the upper hand in the market. While the enterprise value indicates that the TIL-BlackRock consortium has paid a premium for this portfolio, on balance, the strategic benefits likely outweigh the additional cost. M&A is often now the only way to overcome barriers to entry in the sector. And finally, I guess we'd expect that competition concerns may see some secondary transactions arise, as we believe the combination of these two market heavyweights will result in an assessment of excessive market concentration, specifically in Northwest Europe.
Thank you so much, Eirik. Clearly, this is a significant development for the industry, and likely the full implications have yet to be seen, but we will continue to monitor and assess the developments closely. To keep up to date with this story and broader developments in the ports and terminal sector, you can browse our full range of research and advisory services, from market analysis and thought leadership articles to industry forecasts, global terminal operator league tables and performance rankings at www.drewry.co.uk/ports. Thank you for listening, and we hope you will join us for the next edition of the Freight Loop.